If your market doesn't work, what do I need to do to become better? What is my competitive advantage as an investor? Depends where you are in your journey. Different type of real estate investing has different levels of risk. If you're a brand new investor, you may take less risk, and then in return, you may get a smaller cash flow. Don't expect to retire off of the first property, right? It's more important getting experience and seeing the positive results.
Your company is called BRRRR Cash, and that's with buy, rehab, refinance, rent, and repeat. Some may argue, but the interest rates right now is BRRRR in a coma.
Well, I don't think it's in a coma. A real estate investor, if they don't have it yet, they should have the criteria, right? Like, what's the return that they're trying to make, for example, on that BRRRR, right? And then also, too, are they open to exploring new markets? Because just because, for example, that strategy doesn't work in your current market, it doesn't mean it doesn't work in the market maybe 30 minutes away from you, right? As a real estate investor, you have to say, how do I become better? Because people are still investing in real estate every day. So, if your market doesn't work, what do I need to do to become better? Or what is my competitive advantage as an investor? Is it that in my local market, I network with, say, property managers or real estate professionals that have relationship with current investors who are trying to, say, potentially retire, right? So people are still selling real estate every day in your current market and other markets. When it comes to looking at the interest rates, it goes back to running your numbers. Do your numbers work in the current environment? And with this, people feel like the rates are higher because we came from a pandemic interest rates. But reality, real estate investors are still investing now with the current rates as long as their numbers are achieving their returns that they want. And then also, as far as real estate theory, right? When rates are higher, most people are sitting on the sidelines. As a real estate investor, you have to remember one of the things you want is one-on-one negotiation. So use this as your advantage to say, okay, with the rates higher, I may potentially have less competition when I submit an offer. And if you can get that one-on-one negotiation at the higher rates, you may get the price that you need to make the numbers work. And then when the rates go down in the future, you can refinance that asset and improve your cash flow.
So, if somebody asks you, what is good cash flow? Like if you can put your lender hat on, then your investor hat on, how do you think about what cash flow is good enough?
And I'm going to say, depends where you are in your journey. And I say it like that because different type of real estate investing has different levels of risk. So if you're a brand new investor, you may take less risk for your first venture. And then in return, you may get a smaller cash flow. But you got the experience and the positive cash flow. Versus if this is your 10th property, you're more comfortable taking more risk, meaning more risk, more reward, which means a greater cash flow. So for newer investors, I would say don't expect to retire off of the first property, right? It's more important getting the experience and seeing the positive results. Even if it's as low as say they do a turnkey purchase for renter inside and they don't do a rehab, right? It's very low risk and the cash flow is just $100 a month. Just the act of taking action to do that process to start their journey, and then over time they may increase the return that they're looking for as far as a property.
No, those are good words. Sometimes it's hard to convince people of that because they have in dreams they'll buy one duplex and they can retire. It's like, well, it's not really like that. You got to get started, and so some people are concerned. I'm doing all this effort, and it's just $100 a month. Does that make sense? So that's interesting to hear your perspective.
So I do want to add, based on what you just said, is that what the new investor or even like a newer investor has to remember, as you grow and scale and get more properties, the $100 might be $200, and then over time it all adds up and it starts to snowball. So yes, the first property might not be that $2,000 with the first property, but if you start to accumulate and manage it well, and over time it will snowball as you add them all together.